Ethereum's DeFi dominance has collapsed. DEX volumes have plunged, NFTs have shifted to faster, cheaper chains, and gas fees aren't what they used to be. To a lot of people, it looks like Ethereum already peaked. But under the surface, something else is happening. Ethereum isn't dying, it's changing. And that shift might quietly be setting up the most important transformation in crypto since DeFi took off. While most of the attention is chasing hype, serious capital is starting to treat Ethereum less like a playground and more like infrastructure. My name is Danilo, and today we're going to break down what Ethereum is turning into and why that still matters in 2025. We'll cover the collapse of DeFi, the rise of real-world assets and stablecoins, and whether any of this will actually help ETH reclaim its all-time highs. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. Back in 2021, Ethereum was the center of the crypto universe. At its peak, over $110 billion was locked into ETH-based DeFi protocols. Platforms like Uniswap, Aave, and Curve weren't just tools, they were the front lines of innovation. If you wanted to trade, borrow, lend, or farm yield, you did it on Ethereum. At the same time, NFTs exploded in popularity. Projects like CryptoPunks and Bored Ape Yacht Club turned JPEGs into status symbols and made Ethereum the go-to chain for creators and collectors. For a while, it really felt like everything that mattered in crypto lived on Ethereum. But fast forward to today, and most of that activity has dried up. Ethereum's DeFi TVL is down more than 88% from its peak. NFT trading volume has collapsed, and many of the blue chip collections from that cycle are now viewed more as overpriced artifacts than living communities. New energy has shifted to faster and cheaper chains like Solana, Base, and even newer L2s that offer smoother user experiences. It's not just about hype, it's about friction. Ethereum gas fees made even basic actions like trading or minting too expensive for the average user. And while fees have dropped, the damage was done. Many users never came back, and newer wallets onboarded elsewhere. DeFi and NFTs didn't die, they just moved. A lot of DeFi experimentation is now happening on Arbitrum and Base. NFT activity is thriving on Solana. Even meme projects, which once defaulted to ETH, now find their homes on chains that offer cheaper execution and viral tooling. But here's the key point. This drop in activity isn't a death sentence, it could be a reset. What Ethereum lost in attention, it started to regain in clarity. The noise faded, and what's left behind is something much more interesting. A network forced to define its true purpose. Because if Ethereum isn't where the speculation lives anymore, then what exactly is it being optimized for? That's the question most people still aren't asking. Once the speculation completely faded, Ethereum was left with a problem most people didn't see coming. It wasn't clear what the chain was actually for anymore. It wasn't the fastest or the cheapest. It wasn't the trendiest. And the use cases that once made it dominant, DeFi and NFTs, had either collapsed or moved elsewhere. So the question became, what's Ethereum's role now that it's no longer in the spotlight? Instead of trying to compete with every new layer 1 on speed or marketing, Ethereum started leaning into its strengths: decentralization, security, and ecosystem maturity. We've seen the rise of layer 2 rollups like Optimism, Arbitrum, and Base, all built to handle user activity while using Ethereum for final settlement. This isn't a workaround, it's the point. Ethereum is slowly becoming the backbone that rollups and apps depend on, even if most users never touch mainnet directly. We're also seeing Ethereum evolve into a modular-based layer, with innovations like account abstraction, restaking, and intent-based design. The chain is becoming more programmable under the hood, even if most of that innovation happens at the developer level for now. So, while Ethereum might look quiet on the surface, it's anything but stagnant. The network is maturing into something more like infrastructure, not flashy, but completely essential. And that evolution is what makes it more important than most people realize. While the retail crowd chases the next meme coin or low cap alt, institutions are making much quieter moves, and when they enter crypto, they overwhelmingly choose Ethereum. Not because it's trendy, but because it's stable. And nowhere is that shift more obvious than in the growth of real-world assets or RWAs. Real-world assets refer to things like US treasuries, private credit, real estate, and even carbon credits being tokenized and brought on-chain. In the last year, this category has gone from a side narrative to a serious market, now representing over $56 billion in total value. And more than half of that lives in Ethereum or Ethereum-based rollups. This isn't theoretical anymore. BlackRock, the world's largest asset manager, recently launched its tokenized money market fund on Ethereum. Franklin Templeton did the same. Ondo Finance is giving investors direct access to yield-bearing US treasuries via tokenized vaults. Maple is using Ethereum to build out under-collateralized credit markets for institutions, and that's just the beginning. Even if you're not touching these protocols directly, this kind of capital tends to show up early and stay long. It's a strong signal that Ethereum is where big players want to build, even if it's not where all the memes are happening. What's important here isn't just the dollar amount, it's the kind of capital this represents. These aren't degens flipping JPEGs. This is deep, yield-seeking institutional money that values compliance, transparency, and operational resilience. And Ethereum is winning by being the chain that offers all those three. RWAs also changed the game for Ethereum's long-term value proposition. When assets like treasuries get tokenized, they aren't just bought and held. They're moved, traded, used as collateral, and composable across DeFi protocols. That creates ongoing demand for stablecoins, settlement infrastructure, and gas, all things Ethereum already supports. And while RWAs aren't as exciting as a 50x meme coin, the capital behind them is more stable and scalable. Ethereum becoming the default for asset tokenization means it could quietly become the financial backbone of both crypto and traditional markets. That's not just survival, it's long-term positioning most retail investors are still sleeping on. If real-world assets represent long-term capital entering Ethereum, stablecoins are what keep everything moving day to day. And despite the narrative that Ethereum is losing ground, it still dominates the stablecoin market. Over 50% of all stablecoin value, including USDC, USDT, and DAI, lives on Ethereum or its rollups. That's more than 120 billion sitting on top of the network, and it's not just sitting idle. Stablecoins are used for everything. They're the base currency for on-chain trading and lending. They act as settlement tools for DAOs and protocols, and they power more and more real-world use cases, from cross-border payroll to remittances to saving apps in developing economies. What might look like slow, boring infrastructure on the surface is actually one of Ethereum's strongest signals of sustained demand. We've also seen huge growth in usage. As of early 2025, there are over 30 million active stablecoin wallets on Ethereum, a 50% increase from the year before. These aren't just bots farming points. This is real transactional volume, both retail and institutional. And every time a stablecoin is transferred or swapped in Ethereum, that generates gas usage, reinforces the chain's liquidity, and keeps ETH integrated at the protocol level. Put simply, if you've ever used crypto to send money, swap tokens, or get paid, chances are a stablecoin was involved, and chances are even higher that it happened on Ethereum. Other chains have tried to take this market, but Ethereum continues to win because it's trusted. For stablecoin issuers like Circle and Tether, regulatory optics and long-term reliability matter. They're not just going to risk billions of dollars on untested layer 1s. And for users, Ethereum offers a blend of scale and stability that's hard to replicate. It's easy to overlook stablecoins because they don't spike or go viral, but they represent one of the clear signs that Ethereum is still where real utility lives, and where real money still flows. So here's the real question a lot of people are still asking. If Ethereum is powering real-world assets, hosting most of the stablecoins, and becoming this foundational infrastructure layer, will any of that actually show up in the price? Can ETH reclaim its all-time highs? Let's be real for a second. Price only goes up when demand increases faster than supply. That means more people need to be buying and holding ETH, not just using apps built on top of it. And while Ethereum is laying a strong foundation, the price conversation isn't as simple as, quote, more utility equals higher price. Take EIP 1559 for example. ETH is burned with every transaction, which reduces the supply. But right now, on-chain activity isn't high enough to make Ethereum consistently deflationary. During bull runs, yes, ETH becomes scarce. But in this quieter market, issuance still outpaces burn. So while it's a good mechanic long-term, it's not a short-term price driver. Staking is similar. With over 27 million ETH locked up, it removes a big chunk of that supply from circulation. That helps reduce the sell pressure, especially from long-term holders. But again, staking doesn't require anyone new to buy ETH. So if you're wondering whether staking alone can push ETH's price up, the answer is no. It helps support the ecosystem, but what really drives price is new demand and usage. Then there's restaking. Protocols like EigenLayer are creating new yield opportunities for ETH holders by letting them secure additional networks. Over 15 billion is already restaked. That's impressive, but like staking, it doesn't directly create new demand unless users or institutions need to buy ETH to participate. It does increase ETH's utility, but price impact depends on adoption. Layer 2s are growing too. Arbitrum, Optimism, and Base all settle on Ethereum and pay fees in ETH. That's a solid long-term value path. But the fee volume today is still small. As L2s scale, ETH will benefit, but we're just not there yet. So here's the bottom line. ETH is becoming more useful, more trusted, and more embedded in both crypto and traditional finance. That's bullish over time. But the price of ETH won't magically go up just because the tech is improving. Price follows demand, and demand comes from activity, speculation, and real users choosing to hold ETH, not just use the network. So, if you're a long-term holder or trying to position ahead of the next rotation, it's worth paying attention to where the infrastructure is quietly being built, because when things heat up again, that's where capital tends to flow first. What Ethereum is building right now won't trigger instant price action, but it's setting the stage for when attention and capital rotate back into quality. And when that happens, ETH is likely to be one of the assets best positioned to benefit, not because it was loud, but because it stayed useful. Ethereum isn't fading into irrelevance, it's just not playing the same game anymore. It's not the chain chasing the next hype cycle or trying to win the attention war. Instead, it's positioning itself as the foundation that the rest of crypto and increasingly traditional finance can build on top of. The DeFi rush, the NFT mania, and the high gas fee era gave Ethereum visibility, but now, with real-world assets, stablecoins, and restaking, it's starting to build staying power. It may no longer be the chain where all the action happens, but it's becoming the chain where everything settles. And in a market that constantly chases what's shiny, that kind of role might actually be the most valuable one of all. So, will Ethereum survive? Absolutely. But it won't look like a comeback to the spotlight. It'll look more like infrastructure quietly taking over while everyone else is distracted. And for those paying attention, that shift might just be an opportunity. What do you think Ethereum's role will be going forward? Dominant, forgotten, or quietly essential? Let me know in the comments. And if you want more content like this that cuts through the noise, make sure to subscribe and turn on notifications. Thanks for watching, and I'll see you in the next one.